Hi everyone, and welcome to today's webinar on changes to exempt current pension income. Today's presenter will be Meg Heffron from Heffron Solutions. Welcome, Meg.
Hi, Jeevan.
It's just Heffron now, isn't it? Actually, so business. So you say. So Meg's been working exclusively with SMSF since 1998. She's one of the few actuaries to work in all areas of the SMSF practice. She's truly passionate about all things SMSF and wants to, I guess, take great pride in turning technical knowledge into practical solutions for both accountants and advisors, and always use it to, I suppose, grow the SMSF industry and help those advisors and accountants grow their business. She's a sought-after speaker all around the country, and you regularly see her in columns in publications such as the Financial Review, and she's involved in constant consultation with the government and regulators. So welcome, Meg.
Thanks very much, Jeevan. And
so for any questions today, please enter them into the Q&A panel down below, or alternatively the chat panel, and we'll stop periodically to answer those questions where we can. Today's session is recorded, so if you do have drop out at any time, we will send you a link to the recording, and we will send everyone a copy of the slides as well. So I'll pass over now to you, Meg.
Fantastic. Thanks, Jeevan. And I really like the fact that you've managed to invite me along to talk about two things that I'm really passionate about. One is SMSF generally, of course, and the other is it always seems to me a great when I get a chance to talk about ECPI, because I had to work really hard to qualify as an actuary, and I hardly ever do any actuarial work anymore. And the one sort of actuarial thing, of course, that's relevant for SMSFs is ECPI. So it's nice to be able to indulge myself every now and again and talk about ECPI. So thank you very much for inviting me along. And we have got a bit to talk about today. So we know we've got two changes to ECPI that are actually in effect now in 1st of July 2021. We think of them as not being here yet because we're all doing financial statements and actuarial certificates for last year at the moment. But I do want you, as you're sort of working through this session with me, remember that, of course, if a fund gets wound up this year, we are going to be doing a 21-22 year right now. So whilst you may be thinking of this as, good for you in terms of getting in early and being ready for next year, it does have some relevance for this year as well. And there are plenty of the things that I'm going to talk about today which are highly relevant for funds that wind up this year. So the two changes, what are they? I want to start with a very quick refresher on what the world looks like for 2020, 2021 and earlier years, and then highlight what's changed now. So remember, since the 1st of July 2017, we've had this kind of complicated regime where some funds are allowed to segregate and some funds are not. So the test we always do is at the 30th of June in the previous year. So for the certificates you're doing now for last year, it's 30 June 2020. For the certificates you're going to do in the new world, it's going to be 30 June 2021. But the key test is, did any member have a total super balance across all their funds of more than 1.6 million at that time? And did someone who met that condition also have a retirement phase pension in place? So not a TRIS, but a retirement phase pension in place in any fund. And if the answer is yes to both of those questions, then remember, they can't use the segregated method. If the answer is no to either one of them, then they can use the segregated method. And remember that one of the key outcomes of the 2017 changes was all of a sudden the tax office shared with us their brilliant insight that they had always considered it a rule that if you were allowed to use the segregated method and you were in fact only providing account-based pensions or market-linked pensions, anything that's linked to an account balance as opposed to defined benefit, if you were in fact only providing those at a given point in time, then you were required to use the segregated method, even if it was only for part of the year. And we sort of introduced this new term for ourselves, the deemed segregation, where you were deemed to be using the segregated method, even though you might not actually have wanted to. So we had those two test conditions. If you met them both, you can't use the segregated method. You have to get an actuarial certificate for the whole year. And if you didn't meet either one of them, then you could corollary being you must. So what's changed going forward? There's been a subtle change to both of those columns. So for 21, 22 and beyond, for a start, we've got a really sensible change. You don't need an actuarial certificate because obviously you think you can't use the segregated method. I've got to use the actuarial certificate method. If I've got to use the actuarial certificate method, I need a certificate. So there's been an extra rule introduced that says, no, you don't have to worry about that. You don't have to get an actuarial certificate. You can, in fact, use the segregated method if all year the fund was only providing retirement phase, account-based pensions or market-linked pensions. Defined benefits, all bets are off. Transition to retirement, all bets are off. But if you were using if you just had 100%, the classic 100% account-based pensions all year, then even if you met those two conditions up the top, you don't rule yourself out of using the segregated method. You can use it, and therefore you don't need an actuarial certificate. So that was a nice one. That change has been in for a while, or we've had the legislation for a little while. The second one that's more recent is this one, this removal of the requirement to have this deemed segregation. So remember, the old system that we've been living with for the last 4 or 5 years is if you can segregate and you happen to be 100% pension phase, then you must use the segregated method. And the second change we've got is that you're actually not locked into doing that anymore. You can make some choices. This one, we've only had the legislation for this more recently. So the two changes were both announced at the same time in a budget a while ago. Then we had draft legislation for both of them, but the second one was kind of dropped out of the draft because it looked like it was going to be too complicated. The government's come back now and introduced the second change as well. So both are really important. And actually, I've got a question already. I'll come back to that question because that's a really good question. So the first change, what practical impact does that have on you? Okay, so that's the one, remember, where it's basically a nice free pass. You don't need an actuarial certificate if you're 100% account-based market-linked pensions all year in the retirement phase. And it's totally sensible that you don't need an actuarial certificate because what's it going to say? It's going to say 100%. So the practical outcome for you is simply you don't need to apply for the actuarial certificate. So you don't have any choices to make. There are no changes to the tax outcome. So in the past, you got a certificate saying 100%. Now you won't get a certificate, but you'll still claim 100% ECPI. So there's no other practical change. It doesn't change the treatment of capital gains or capital losses or the ECPI calculation itself. It's just everything is ECPI. It's in that sense there's no change. The key change is your client doesn't have to obtain or pay for an actuarial certificate. Makes perfect sense. The second change is where you have some choices. So in the past, if you had a situation where a fund could segregate and had a period where they were 100% retirement phase pensions, then they didn't have any choice. They had to use the segregated method during that period. What's changed is we now have a choice. There's no more automatic deemed segregation, although that is the default. What will happen instead is the trustee can make a single choice for the whole year to either do that, the default position, so still treat the year as if it's broken up into different chunks, some using the segregated method, some using the unsegregated method. Perfectly fine to keep doing that, and the BGL software already accommodates that, as you know. Or you can choose not to do that. You can choose to have a single actuarial percentage for the whole year. It's applied to the whole year's income, and you can actually make that a different choice each year. So one of the reasons I wanted to go through this session was to highlight for you how you might choose, or how a trustee might choose one approach or the other, because it's a choice they can make every year if they're in this position, if they have some periods of the year when they're totally in pension phase and some periods when they're not. I've already had a question on whether the BGL software can accommodate this. Totally. So actually it already can, if you think about it, because if you think about one of the things that you can already do is you can tell BGL that you've got super in another fund. as soon as you do that, it thinks you can't use the segregated method. And so you'd get that second option. Now, BGL's already working on, in fact, Jeevan, you might be able to update me on where that's at. BGL's already working on a better system for that. So a tick box or some kind of option that allows you to express which choice you've made. But even before that work is done, you can actually give it a trial run simply by telling the software that you've got money in another fund. Is there anything I've said there, Jeevan, that I've misrepresented how things work on BGL? But I actually thought when we were emailing, your solution sounded really neat.
That is correct. So currently within our software, you're able to see the total super balance for each member during the actual certificate process. You choose whether the fund is eligible for segregation or not. In the next few months, we'll also accommodate for the ECPI choice. So that will be enhanced even further, covering some of the content that Meg's going to cover today.
Yeah, no, that sounds brilliant. So you are effectively, BGL is going to make it really easy for you to do two things, really. Get your actuarial certificate provider to give you sort of draft answers on both fronts, so you can, decide which one makes sense for your client. But also, you don't need to go and do a whole lot of work to change your mind. It'll be tick boxes in BGL, which I think is brilliant. Okay. So the purpose behind that second simplification. So the first change, the don't get an actuarial certificate if you obviously don't need one, that makes perfect sense to all of us, I think. Even to me, to be honest, whilst I love doing actuarial certificates, I also like to think that when we give you an actuarial certificate, it's actually useful rather than telling you it's just 100%, which you already knew before you asked us. So we are quite quietly delighted that you don't have to ask us for those nonsense certificates anymore. The second change is, I think, the more profound and important for you and for your clients, and that is the one where a fund that looked like this. So see, I've got periods here where, yeah, it's all in accumulation phase, or it's a combination of pension and accumulation phase for the last 3 months of the year, or it's all in pension phase for the middle 6 months. Now, when I talk pension here, I mean retirement phase pension, account-based pension that's in retirement phase. So you look at this under the old system, if this second change hadn't come in, and you're all aware of, I'm sure, of how it works today. You basically look at that period in the middle and you say, right, well, in that period, I've got to use the segregated method. So all my earnings during that time is ECPI. For the other two periods on either side, I know I need an actuarial certificate, and you send the data to me. Well, hopefully you do. You send the data to Heffron, and we do this sum. We say, what's the ratio of the pension accounts to the accumulation accounts over that sort of 6-month period that's split into two bits? And we come up with an actuarial percentage of about 40%. And then when you get it back, what BGL's doing behind the scenes is just applying it to the correct periods. BGL is saying 40% of your income in the first 3 months and 40% of your income in the last 3 months. That's all ECPI, but the bit in the middle, that's 100% ECPI, because in that middle period, you were deemed to be segregated. So that's how things work at the moment. What will happen going forward is you'll actually have a choice, and you'll be able to say, look, I don't really want to do that 40% to the two periods of income at the either end of the year. I just want a simple single actuarial percentage. Heffron, what is it? And I'll be saying, well, it's looking at the whole year rather than just dividing those two bits off. I'd say, look, it's more like 66% if I go for the whole year, way higher than 40. Because if you think about it, for half the year, this fund was totally in pension phase. So you'd get 66%, you'd apply it to all income over the whole year, not just the bits at either side, and you wouldn't get 100% ECPI in that middle 6 months. Even the bit in the middle, where the fund was totally in pension phase, you'd only get 66%. So this second change is designed to give you that choice. Do you want 40 for the two periods at the end, or do you want 66 for the whole year? And then, the obvious question is, well, how will I choose? How will I pick which one? And a key point I wanted to highlight is sometimes nobody cares. So sometimes if the income really is just steady, it's regular throughout the year, you'll actually get the same or virtually the same answer either way. And I just put some, I promise this is the last bit of my slides. It's going to be numbers heavy. I really thought hard about whether I should have lots of numbers, lots of calculations. I thought, we're a team, you're accountants, I'm an actuary, we love numbers. And then I thought with this particular change, actually, oftentimes you don't really need to see the numbers, you kind of need to see the concept. So numbers heavy here, but I promise not very many numbers and calculations in a tick. So for this one, if you just had $10,000 every month coming in as your income, and you wanted to say, well, what's ECPI under both of those two approaches? If it was the first method, so we're going to use a combination of segregated for the middle 6 months, 40% ECPI for the 3 months either side, then this is how we'd calculate ECPI. We'd say, well, it's 40% of the first 3 months income, 40% of the last 3 months income, and all of the income in the middle. So ECPI is about 84,000. If we just had 66% for all of the income all of the year, see how the answers are almost identical. And in fact, the difference is rounding. It's me being imperfect with my maths. In theory, this should give identical results if the income is even. So from your perspective, if you're trying to make this choice and you look at the income and it's pretty steady throughout the year, you know, the main asset is a property which paid rent throughout the year. Don't worry about the expenses. It's all about the income. Rent throughout the year. You might say, look, it doesn't matter. I'll just take whichever one is easier for me and go for the, you know, whichever one of these you find easier to do or to explain to your client. In both cases, you need an actuarial certificate. I assume most actuarial providers are exactly the same as us. The cost will be the same regardless of which actuarial certificate you actually need. And, you know, then the sort of exciting part, the bit that we'll be thinking about throughout this session is an answer to another question we've got already. You know, how are we going to choose between the two methods? So the question I can see is, does your actuarial certificate do analysis so we can determine which method is tax effective for the fund? The certificates won't themselves, because if you think about it, it's like having 2 audit reports, or, you know, our certificate is a statement on the outcome after you've made the choice. And we only get one data set from BGL, which tells us this fund is segregated or it's not. But you have a really easy mechanism when you're using professional software like BGL, you have a really easy mechanism to send 2 requests through. Don't finalize either of them and decide once you get the certificate back or once you get the percentage back and you apply it to the income at the different times, you know, you can then look in BGL and say, right, well, I get a bigger ECPI amount under this approach than I do under that one. Or, you know, now that I look at it, my capital gains suggest I should go this way rather than this way. You'll be able to make all those choices by effectively getting all the data you need from BGL. So, what are the typical client scenarios we might be looking at where we'll want to make a choice? We'll want to think about, you know, I've just sort of said that if the income's really regular throughout the year, the choice is academic. Nobody, it doesn't really matter which way you go, you'll get roughly the same answer. So what I thought I'd do for the rest of the session is think of what are the client scenarios where the choice does matter, and what sorts of things would you want to take into account in order to make your choice. So a couple of different scenarios. Here's a classic. So you've got a fund that starts out and it's 100% retirement phase pensions. Then there's a new contribution that goes in. So for a time, it's a hybrid. And then you convert that contribution to a pension eventually. And so you go back to being 100% pension phase. That is one scenario where you might make this choice. I've got 4 scenarios. I want to paint a picture of all 4 and then use each one to make a different point about how you might make the choice. So just let me explain the scenarios first. So that's one where you start 100% pension phase, new contribution comes in. So for a time you're a hybrid, and then you convert that to a pension. So you go back to being 100% pension phase. Another one, and this is also a classic, you might be accumulation phase or TRIS for a long period at the beginning of the year, then the whole fund moves into pensions at a given point in the year. I think even before things changed in 2017, people were used to and comfortable with using the segregated method for that second part. Then the ATO came out in 2017 and said, you must do it that way. This will give you a choice, even for those clients. And there are some particular issues that pop up for people with that scenario. Another one that's different is your retirement phase pension all year and then new contribution right at the end of the year, and you're a hybrid just at that point. And the last one, which we might even bump into this year, is where you're winding up pension phase, and then effectively you do a full commutation in order to stop all the pensions and then roll them over to another super fund. And so there's this little period at the end where you are, totally in accumulation phase because you've stopped all the pensions to roll them over. So I want to use each of those 4 fund scenarios to highlight how you might behave differently now that we have a choice. How might you make the choice? A lot of the issues that I'm going to raise for each of the 4 actually apply for all 4, but I want to use each one to sort of draw out a different point. Jeevan, please feel free to stop me if I'm racing through too quickly and you're getting questions that you think we should answer.
No, it's real good. We got one question before, though, probably a few people were commenting on, so I'll answer that in the chat window, Meg. David's asked, he's got a SMSF with a single member that has both an accumulation account and account-based pension. Yep. At 30th of June 2021. It's over 1.6 million in terms of the total super balance.
Yep.
Then at 1st of July 2021, a lump sum of the entire balance of the accumulation accounts taken out, I assume. So you're left with the pension. So I guess the question there is whether a certificate's required in terms of what happens there on 1st of July when the transaction's there.
So total super balance is more than 1.6 million?
Yep.
Yep. Look, I guess technically you do need a certificate then because you haven't been wholly in pension phase all year. I think, to be honest, that would probably be the safest way, because you can't use the segregated method and can't rely on the fact that you were wholly in pension phase all year. I think what I would argue, if instead of cashing it out, you were converting it to a pension, then what I would try and argue is, I converted it to a pension at a minute past midnight on the 1st of July. So yeah, I really was in pension phase all year. I think when you're cashing it out, it's slightly harder because it's going to be, 1st of July, 2nd of July. It's going to be, a transaction that's physically coming out of a bank account that clearly didn't come out at 1 minute past midnight. So to be safe, especially given that they don't cost much anymore, to be safe, I would get an actuarial certificate in that scenario, even though you would think, that kind of doesn't make sense. They should be able to claim use that first change I was talking about, which is I'm 100% in pension phase. Surely I can avoid getting an actuarial certificate.
That's it.
Okie doke. So if I use this first example to illustrate one of my, how you might make a choice here. So this first example, remember, we started off totally in pension phase, then a new contribution came in. So it was a hybrid for a little while. And then it went back to 100% pension phase because that new contribution was either cashed out or turned into another pension. So a key thing, if you make the choice and say, I want to get one actuarial certificate for the whole year, I want to not use the segregated method at any point in time. Just one point to highlight is you can't pick and choose. So you couldn't say, for example, I'll just combine the first 2 periods of the year and get an actuarial certificate for those, and I will treat the fund as segregated for the last part of the year. You actually can't do that. This choice is a binary thing. You either get a certificate for the whole year for all income, all accounts, nothing is ever segregated, or you say, I'm going to just segregate. I'm going to go for segregation for the first part and the last part of the year. I'm hoping that makes sense. Now, don't forget, that doesn't mean you can't have you can't elect in advance to have a specific asset that is segregated. That's a different that's a different issue. But what you can't do is use this new choice that we've got in the legislation. The new choice being I won't fall into that trap of deemed segregation. You can't use that new choice selectively. You're either making the choice for the whole year or you're making the choice for none of it. So if this person was actually weighing up that choice, and I noticed one of the questions was about June trust distributions. You'd look at this fund and you'd say, right, well, if all of the income was trust distributions that were made in June, which is not crazy. If, or even if a very large part of it was, you think about how managed funds that are predominantly international shares, I think the trust distributions are skewed towards the end of the year in those quite often. You think about a client who's investing in a private unit trust where there is only one distribution and it's all made in June. Even though the cash might not be received until July, of course, for tax purposes, this is treated as a distribution made on the 30th of June or in June. So this fund might say, I'll just stick with the default. I know we've got a choice here, but I'll just stick with the default. And because the default allows me to treat all of my income in that last period of the year, including my June distribution, which was the vast majority of my income, allows me to treat all of that as ECPI. So that's what I'm going to do. I'm not going to make this choice. It feels simpler. It looks like it might be an attractive option to have for other funds, but for this particular fund, I'm not going to make that choice because sticking with the standard method, the default method, I get all of that June distribution as ECPI. Instead, though, if I had the situation I outlined before where the income was kind of regularly spread throughout the year, then I might make the choice to get a single percentage for the whole year that applies to all income, because I might say, look, that's simpler to explain to my client. It's simpler for me to verify that it's correct. I will use that method because I perceive that to be simpler. Either way, you're going to need an actuarial certificate for this fund at some point, aren't you? Because even if you've got any income in that middle period at all, you're going to ask for a certificate that covers the income in that period. If you make the choice that we're talking about here, you'd get a certificate that covers the whole period. It's the same to you either way. I suppose if it really was literally every single dollar of income arrived in June in that trust distribution, deciding to just stick with the standard method, use the segregated method for the two periods in green, would mean you'd get ECPI for that June distribution, and you could avoid getting an actuarial certificate altogether. If you think about it, actuarial certificates aren't like audit reports. They're tax documents. So you only need an actuarial certificate for ECPI with an account-based market-linked pension if you want to claim ECPI on the strength of that certificate. So if you were in this fund using the segregated method and you said, I didn't actually get any income in that blue bit in the middle, so I don't even really need an actuarial certificate, you just don't have to get one. You would just use the segregated method for that June distribution and you would say, that's my ECPI, all of my income is ECPI. The other scenario, or the second scenario I showed before, was 100% accumulation phase or a transition to retirement pension, then moving wholly to pension phase partway through the year. And I said, well, that's another scenario where, again, we now have a choice. If this fund is allowed to segregate, which, it probably will be, won't it? So imagine there's no other money, no other super money in any other fund. If this fund was totally in accumulation phase or in a TRIS at the beginning of the year, you think about that test that applies on the 30th of June. 30th of June, did any member have more than 1.6 million? Well, they may well have. Did they also have a retirement phase pension in place? Well, judging by this, no. So almost certainly, no matter how big this fund is, this fund can use the segregated method. So in the past, it would have been required to, because partway through the year, it became 100% retirement phase pension. Now we've got a choice. How might we make that choice? One thing to think about seriously is whether we're making capital gains or capital losses. So what if we had a lot of losses carried forward and we'd made gains, but only in the pension phase? So we might say, well, the great thing about capital gains when you're using the segregated method is we just completely disregard them. So that would be neat. We'd have losses carried forward from the past. We just keep carrying them forward. We don't have to offset those gains that were made in pension phase. That might be a very strong incentive to use the segregated method for this fund. We get to keep carrying forward those losses over time. They might become really handy eventually. You know, we think about a fund that's 100% pension phase not needing losses, but remember, of course, things change these days, don't they? You know, now that we've post 2017, we're in an environment where it won't be uncommon for when one member of a couple dies, some money gets paid out of super, possibly some goes back to accumulation phase. That switch from full pension to hybrid is probably going to happen more than it used to in the past. So hanging on to these capital losses for the time when you go back to needing them again might be really neat. So this fund may well say, I'm going to stick with the default method and use the segregated method because it gives me the opportunity to ignore those capital gains and not use up any of my losses. Equally, I might have a situation where I've actually made losses in the accumulation phase and I've made gains in the pension phase. Again, not talking about carried forward losses this time, but hey, that's handy. If I've made losses in accumulation, gains in pension phase, well, the losses, I can hang on to them. I won't be offsetting them with the gains that I made in pension phase. So under that scenario, this fund might say, hey, that's not a bad idea. I'll hang on, I'll just use the default method. As an alternative, if the capital losses and gains were in completely different places, they might make a very different decision. So good example here, made a loss in pension phase. Don't forget the downside with losses in pension phase, if you're segregated, is they get disregarded. You don't get to carry them forward. But what if I made losses in pension phase and I do want to carry them forward? I haven't made many gains this year. I've just made a big loss while I was in pension phase. Very strong incentive to use the choice to say, I will get a single actuarial certificate that applies for the whole year. No period will be segregated. And therefore, if I have made a big loss that I haven't used this year, I get the opportunity to carry it forward. So you can see, just if we hone in on losses and gains, you can see there are different scenarios that might using the segregated method attractive versus using the single percentage across the whole year attractive. Okay, I can see a few questions. Actually, I can't read them very easily from here, Jeevan. I've best laid plans and all. My apologies. You need to get a younger presenter next time so that I can see them. I'll just move them a little bit.
Oh, good. I can read them out to you if you like. So a question there from Graham. Must trustees request the ATO discretion for a payment of a death benefit made after 6 months of death? What penalties may apply?
Right, so you don't actually have to request any discretion to be exercised specifically. There's just a general rule in superannuation law that says death benefits have to be paid as soon as practicable. If it's, and the ATO's general advice in the past has been 6 months is what they consider reasonable. Now, if it extends out beyond 6 months, the only risk you face is that at some point the ATO may come back and say, hang on, that was a very long time to pay out that death benefit. In practice, most of us who work in SMSF would know it's common for death benefits to take longer than 6 months, even when it's pretty clear what should be done. So personally, in our practice, we tend to not get too hung up on the precise 6 month anniversary. It's not a legislative deadline, but we do use that as a guide to saying, look, letting it hang around for years isn't the right thing to do. So let's make sure there's activity that gets it dealt with reasonably promptly after that time. I've got a question from Peter. As an auditor, where the ECPI is different to the actuarial percentage, what should the auditor do or auditor get to verify it's correct? Now that's a really good question. I don't know the answer to that. I guess I would have thought, whilst, obviously tax is the tax agent's problem, not the auditor's, I guess you still have a problem, Peter, if that results in a material misstatement of the accounts. I guess, is it necessarily easy for the auditor to tell that they're different, because you know what I'm saying in my certificate, 66%, but you can't necessarily go and just apply that to the income, because you don't know, you don't know whether there was a segregated period or anything like that. So I'm not actually sure. I'd be interested to know what other auditors in this space find when they feel they've got a real difference. I have had a couple of calls in the past from auditors wanting to verify that, why is the percentage, actually particularly around funds that look like the very funds this problem is designed to, this change is designed to fix. Funds where they look at it and they say, I would have thought your percentage would be 66%, Meg, but you've said 40%. And I have to go through and explain that, yes, that's because I ignored a whopping great period in the middle when the fund was 100% pension phase. I think it's very difficult actually for auditors to be able to pick up on errors here, because you don't necessarily have all the information.
I must also say, Meg, in Simple Fund 360, there is 2 reports. The exempt pension reconciliation report and also the non-deductible expense report. So each of those reports will detail the, list of items, list items of income, for example, and what percentage was used. So where there is multiple percentages, that you can easily find through that. So if you're requesting reports from the accountant, you can request those reports. So.
Yep. Okay. That sounds brilliant. That's really helpful. If I just turn to another of my 4, remember that I sort of showed up 4 options at the start of this segment, where I was talking about 4 funds that looked really different, and how might you make a different choice. So another one here, which I think is quite common, you start off and you're totally in pension phase, and then a downsizer contribution comes in towards the end of the year, or even a concessional contribution or something like that. And at that point, you've got a hybrid state for that last little bit of the year. And again, we've got this choice now. If this fund can segregate, now it's not required to for that first part of the year. It could choose to get a single percentage across the whole year. So in terms of how we might make that choice, again, similar principles apply. If all or most, the vast majority of the income was while it was 100% pension phase, you might say, I'm going to go with 100% ECPI during that period. I recognise that I'll only get a tiny bit of ECPI for the last little period, but that's okay, because most of my income was in that period where it was wholly in pension phase. So in that case, I will default to the usual method. I will use the segregated method for the first bit, and I will get an actuarial certificate for the last bit. But I might make a different choice and just get an actuarial certificate that covers the whole year if actually it was the other way around. And this, again, we could return to that, June trust distribution, or a large capital gain or something like that. If a very large part of the income was received in the last part of the year in this example, you think about how I would do my actuarial certificate calculation if I was looking at a whole year versus just part of a year. It's all maths, right? It's averages. So I'll just use an extreme example to illustrate. Let's say the pension account is 300,000 and the accumulation account that's in that last little bit of the year is also 300,000. It's a downsizer. Now, I'm picking an extreme example because the maths is easy. So if I'm just doing an actuarial certificate that covers that last bit of the year, I'm ignoring all the segregated period, then no matter how long that period is, you're going to get about 50% in your actuarial certificate, because the pension account's 300, the downsize is 300, it's about 50%. So if all your income is a June distribution, you'll only get 50% of it as ECPI. But if that little period was only like a month, and for the rest of the year, it was 100% pension phase, it's going to be way higher than 50%, because the average, you get dragged up by the fact that it was 100% pension phase at the beginning of the year. So even though all of the income was received in a period when the fund was 50-50 pension and accumulation, you can get a much higher percentage if you just get, if you make the choice to not use the deemed segregated period and go for an actuarial percentage that covers the whole year. So that's my third alternative, the last one. Now, this is one that we'll bump into this year. If we've got funds that are winding up this year, this is actually a consideration we should be factoring in right now, because we have a choice now that we haven't had in previous years. And remember, even though none of the software providers have been able to adjust for this just yet and have the right, all the helpful tick boxes and stuff that the BGL are going to have in due course, you can still use this simply by telling your software that the fund is not able to segregate. And that will give you, that will allow you to work out which one is best for you. So let's say we had, in this case, funds 100% pension phase, and then the decision's made to wind up the fund. So the pensions are fully commuted and the amounts go back to accumulation phase, and then they're rolled over. This happens in particular if you've got an in specie transfer to a new fund or out to the member, because remember, the legal order of events is the commutate, or you can only roll over or pay out once you've commuted it. If you elect to fully commute a pension, it ends, and ECPI ends as soon as the commutation occurs, and then the subsequent payout is coming from a fund that's 100% accumulation phase. Partial commutations are different. ECPI keeps running, but full commutations, when the commutation is effective, ECPI ends. So if you had a case like this, what might you do? Well, if all of the assets were sold while it was still in pension phase, or they were sold after the commutation occurred, but there were carried forward capital losses, because don't forget, we're winding up this fund, so we have no use for them in the future. They were sold after the commutation, but there's enough carried forward losses to absorb them. You might stick with the default and go for the segregated method. Alternatively, you might choose not to do that if there were very large gains made after the commutation. And the classic for that, like I said before, is an in specie transfer. It's why actually in the past, to get around this, what we've often done in our practice where it's going to be an in specie transfer, so we've actually done it in two bits. We've done a partial commutation first, so you can make the payment from a pension that is still running, and then a full commutation last after we've already, after there's only cash left. But we don't need to bother with that two-step process anymore. In this case, we could now say, okay, I'm going to get an actuarial certificate for the whole period. I'm going to make the choice we're talking about here. And because the period between commutation and when I paid out the assets was tiny, it was a couple of days, then even though it was the whole fund for that couple of days, and even though that's when all of the capital gains were realised, you'll lose it in the rounding. The actuarial certificate that will come back for this will still be close to 100%. So this is exactly the sort of scenario where this choice might be highly valuable to you right now, today. So how will you know which method to choose? We've talked about a couple of different options. Sometimes it's obvious. So sometimes you've got large capital gains or losses made at a particular time, or you've carried them forward from the past and you want to, you've got large capital losses carried forward and you've made gains while you're 100% in pension phase. You'd really like to be able to disregard those gains and keep carrying your losses forward. Or you've got very uneven income, the June distribution one being a classic case, but equally, for whatever reason, a very large term deposit interest payment or all sorts of things can be uneven if you think about it. Even dividends from shares, they're uneven, aren't they? They happen at particular points of the year. They don't happen, all month, every month. If you've got no idea, if you're really not sure, then don't forget, if the income's regular, it won't matter. So do whatever you like. But if you are not sure about that, then don't forget you can run the fund through its paces on BGL twice. Get an actuarial certificate both times. I think pretty much every actuary in the country is the same as we are, which is if you get one and then you ask for an update, you ask for that to be replaced with a new one. We don't charge you twice, we only charge you once. And equally, you can usually get a draft, output from the actuary on and choose which method gives you the best result. And don't forget that choice can be made every single year. You don't, just because you make a choice not to segregate this year doesn't mean you're locked into doing the same thing next year. Oftentimes it won't happen because oftentimes you'll you will only have every now and again where the fund is 100% pension phase and not during the same year. Usually if you move into a hybrid phase, you stay there until, for example, the accumulation account's cashed out or something like that. But if you do have a situation where you want to make the choice, BGL makes it pretty easy for you to get all the data you need to be able to make the choice. And the key at the end of the day is not how will I get the biggest actuarial percentage, it's how will I get the best ECPI outcome, which is really about actuarial percentage and when the income was earned. One of the things that I know we're going to distribute after this is, for all of you who are on this webinar, we've got we've recently launched some online education where we do a number of what we call education bites, a number of small little segments on individual superannuation issues. And there are a heap of them, obviously, but 2 of them we've done are very specifically on ECPI, picking up on how this choice works, how the, when you might make a different choice, all those kinds of things, giving you a lot more detail than I've gone into today. And also, segregating in practice. What does it actually look like to make a voluntary choice about segregating? So just a flag, if you do end up doing the, doing the free trial on that new education platform, two of the modules in there are all about this issue and giving you help on how you might make the right choice for your client. Don't forget, of course, there are some people who can't make the choice. So I've kept talking throughout here. I've taken 2 shortcuts, which I probably shouldn't have taken. I keep talking about pension phase. So don't forget, when I'm talking about pension phase, I mean retirement phase pensions, not TRISs, and I mean account-based and market-linked, not defined benefits. Rules are totally different for defined benefit funds. Basically, they need an actuarial certificate come what may. So that's one of my shortcuts. And the other is I've just talked as if you're allowed to segregate. Of course, there's a whole universe of funds that are not allowed to segregate at all. And they're the guys who have to say yes to both of these questions. The total super balance at the previous 30 June was more than 1.6 million. And also, whoever had one of those, or any one of the people who had a total super balance at this level, also had a retirement phase pension in place. Those people don't have a choice, so we're just back to the actuarial certificate all year, and the only thing that's changed for them is if they've been in pension phase all year, they might not need an actuarial certificate at all. So to sort of bring this to a close, and then I'm happy to take a bunch of questions if that's useful, Jeevan. We have got a new ECPI environment. It's here right now. We think of it as a thing that doesn't happen till next year, but actually you're winding up funds right now and it's relevant for them right now. The first change, people who are not allowed to segregate but were 100% in pension phase all year, no more actuarial certificates. The second change, no more forced segregation for people who are allowed to segregate. They've got choices. And the right choices, like I said before, are driven by not just how do I get the biggest actuarial percentage, but also when did I earn my income? Have I got capital gains, capital losses, both the current year and carried forward? So that's it. I might hand over to you, Jeevan, if I could,
okay,
to ask me any questions.